When inflation does pop its head up, like it did in the 70s and has at various times throughout history, repeatedly, it is something that affects everyone and dramatically. And how is that? So if I'm a wealthy investor and I own a number of investments, including a lot of real assets, they tend to benefit from inflation, or at least protect me from inflation.
If you're watching this on YouTube, make sure you smash that like button and click subscribe. For those of you listening on a podcast platform, be sure to subscribe on whatever platform that is and leave us a rating if you can. The more likes, ratings, and subscriptions that we get, the more we can spread the message and grow our community. So we also have a free Facebook group. It's called the Average Joe Finances Network. Check us out, join the group, join the community, ask questions, and become a part of the team. All of our other social media accounts are listed in our flow page, and we have them in the video or podcast description below. Hey, how's it going, everybody? So today's guest is Ravi Sood, and Ravi is an entrepreneur with a focus on emerging markets. He's the co-founder and former CEO of a Toronto-based investment firm and co-founder of various other businesses around the world, including Galane Gold, Ltd., which is a gold producer operating in Africa and the United States. Ravi, that's pretty cool. You're probably the first person I talked to that's an active miner of precious metals, which is really awesome to talk about. So welcome to the show.
Thank you. I've been looking forward to being here, and we're certainly a rare breed these days.
Awesome. Yeah. So speaking of being a rare breed, I just gave like a small brief background on you, but if you could, can you share a little bit more about yourself, share your story? Like, how did this all get started for you, and why did you start mining gold?
Yeah, absolutely. And it's a long, circuitous journey, because let me tell you, when I started in the professional world, I certainly had no interest in precious metals or mining for that matter. I was entering the workforce in the 90s, in the go-go days of the dot-com boom, really coming from a career path that I thought was taking me to academia. I studied mathematics in university and I was accepted into graduate school and fully intended to go. I had difficulty with figuring out how to fund that, and decided to take a one-year pause before starting my master's degree, and I thought ultimately my PhD in mathematics, and pursuing a career in academia, as I said. And that pause landed me in the investment industry, and that's not something I thought I'd ever get involved with. I had no educational background, frankly, no historical interest in it. And it was really a fluke, a friend of a friend, and an introduction to a former physics professor who had turned for Deutsche Bank, at that time, the division called Deutsche Morgan Grenfell, later Deutsche Bank Securities. And I spoke to that former professor and I said, look, I don't know anything about economics or accounting or stocks. And he said, don't worry about it. We'll find something productive for you to do. And I fell in love with it. And I guess for the most part, I never left the investment industry. But that was the beginning of my career. And I could tell you, in the 90s, when I first started meeting companies and meeting management teams and learning about different industries and carving my path as an investor and developing my own interest and style, I saw the odd mining company and the odd gold mining company come through my office. And I remember thinking, A, what on earth do we need this stuff for anymore? B, these guys are all really old and super boring, and their presentations were awful. And I just had absolute zero interest in mining or gold or precious metals in general at that time. And why would you? It was the go-go days of the internet, as I said, and dot-com was happening and the world was changing. And it was just really a sort of a backward notion to be involved in any of those things. Also, by the way, the economy was truly booming. The United States was actually reducing its debt, as was much of the many other sovereign states around the world. And so the case for gold was really not there. It was at $250 an ounce. So just not something that appeared on my radar. And I continued into the 2000s involved in the investment industry, mostly interested in growth industries, got interested in other more defensive type industries post 2001 and post the tech wreck of 2000. And just very much at the end of that sort of bull run, did I start to get interested, or my interest was piqued on gold, and starting to wonder, how does this all end, like this game and this sort of cycle that we ended up in with this continuous issuance of debt, expanding balance sheets of sovereign nations, and really this growing debt bubble. It was a mortgage bubble. It was a corporate level debt bubble in the 2007 to 2009 global financial crisis. Of course, kicked off with subprime, but then touching basically all aspects of capital markets. But now, fast forwarding to now briefly, it's a sovereign bubble. It's add a few extra decimal points, or move the decimal point a few notches to the right. Orders of magnitude larger bubble. But I really started to get that interest in the mid 2000s. And in 2010, I sold my investment firm. At the time I was CEO. I had started that investment firm with backing from a family office in 2001. And that was an opportunity for me to say, what am I going to do as an individual? Where am I going to spend my energy and where am I going to achieve joy and interest in life? And where am I also going to hopefully make some money for myself and ultimately other shareholders? And I really had developed a firm belief that we were going to see huge inflation. We were going to see a debt crisis that would make the global financial crisis of '08 look puny by comparison, would really amount to a financial reset of the system as we know it. And that real assets can be different things. It could be real estate, it could be lumber, it could be Beanie Babies, it could be NFTs, now different digital forms of real assets. And could it also be gold, that sort of relic of days of yore? Is there an opportunity in that? And after many years on this journey, I've become a firm believer that in the monetary system, the global monetary system going forward, we will see what amounts to a reset. It might be gradual, it might be sudden, but that system needs an anchor. And there's some new argument in recent years, convincing arguments, compelling arguments, where it could be a digital asset. And that is a possibility. And that's something that anybody who's considering precious metals needs to also consider and wrap their mind around. But even as that sector evolves and becomes more important to global capital markets and to individuals and how we conduct our lives, by the way, I'm a firm believer and active participant in those opportunities, and hopefully more active in the coming years. I still come back, which I can go into in greater detail at some other time, to gold in particular as an anchor for the financial system, and for a long list of reasons, but there's probably a few that are most critical. So just, you asked a very simple question. I gave you a bit of a rambling, overly detailed answer. But for me, it was really a 15+ year journey to go from not knowing what gold was to knowing what its role was and somewhat mocking it, at least to myself, certainly having no interest in it, to getting interested and then ultimately going as far in the other extreme as possible and actually starting a company and now that owns and operates 3 gold mines. And really that's my principal investment in precious metals is through that, although I do have many others. But that is the primary one. So long journey, and going from, I think, almost one bookend to the other in terms of extremes, in terms of interest in gold and precious metals.
Right on. Yeah. I want to dive into that a little bit because, and first of all, I like the answer to that question. It wasn't too much. I like the detail because it's important to know the background of what got you into this position where you're at right now with being interested in mining gold. So that's looking at everything else that happened, and you're looking at this gradual reset that might come. Well, could be gradual, it could be sudden, like you said, but it is, very likely to happen because at the rate things are going, if it doesn't happen, then we're going to see inflation through the roof, which we're already starting to feel some of that right now. So I want to talk to the hot topic nowadays is crypto mining, right? So you'd also brought up NFTs too, right? And that's very popular in the crypto community. So you were talking about both collectibles as real assets and then also NFTs. With that being said, crypto mining versus mining gold, right? So crypto mining is like the hot thing, but right now you don't do that. You mine gold. So why gold and not a digital asset such as another cryptocurrency?
Yep. And I'll answer that in a few different ways. First off, I have mined crypto, specifically Bitcoin. I also started a renewable energy company about 8 years ago now. And in 2018, We allocated part of our energy production. It's 100% renewable energy, about 3/4 of it from wind and most of the rest from solar, a little bit from hydro, to powering Bitcoin mining. And as I started to learn about it, casually interested in Bitcoin, and it was sort of a tech kind of thing and new and cutting edge thing. So I had a bit of a casual interest in it. But then as I started to learn more about it, being a mathematician by training, and also somebody interested in monetary policy, it just was like all my worlds coming together into one magical thing called Bitcoin. And it is just absolutely breathtakingly elegant. And I'm both a fan and a critic of Bitcoin. But the one part I just can't be critical of is just the blueprint of how it's designed. And a lot of it, in so many ways, Bitcoin, including the proof of work aspect to mining Bitcoin, it's almost as though it was patterned exactly after gold. And so there's one difference where there's a hard cap on the number of Bitcoin that will be mined. That's possible for that to change, but it was designed with that hard cap, whereas gold does have a very slight increase every year in the amount that's above ground. It's typically been about 2% a year, and in recent years it's dipped below that for a variety of reasons. But the way Bitcoin grows its supply base, the way it's mined, the nature of how the algorithm works or how it plots it out with the difficulty rate, it really mimics some of the aspects of the gold mining industry. And those aspects or characteristics of gold mining aren't something that apply to modern day gold mining. It's applied to gold mining for thousands of years. As your monetary base expands, as your society or economy experiences inflation, the costs of doing things in that economy go up. And gold mining is no different. So as societies or economies grew and evolved, they experienced inflation. That's been a universal truth for the several thousand years of human history. And the costs for industries, including gold mining, go up. They're also sticky downward, particularly for gold mining. I'll give you a specific example, and we can apply that to Bitcoin as well. And it's very interesting when Bitcoin has these radical moves, because it really comes into play. The price of gold in 2000 was about $250 an ounce. And some gold miners were profitably operating there. Gold's about $1,750 an ounce as of the day of this recording. And the profit margins for even the best gold miners aren't much different than they were when it was $250 an ounce. A little bit better. So how on earth is that possible? that was just 20 years ago. What's happened to those gold miners? They were making money at $250. How are they not making absolute windfall profits at $1,750? The answer is inflation and costs, just inflation in everything. And as the price went up in 2011, it went over $1,900 briefly. Those operating costs specific to that industry went up. They went up and up faster than the rate of inflation in the broader economy. Then the price of the commodity came down, and the cost of production came down a little bit, but it didn't follow it all the way. It certainly didn't plummet back to $200 an ounce. So it was sticky downwards, to use the macroeconomic term. And that helps reduce the supply of gold when the price is going down, helps mimic also the general characteristics of the economy of inflation, deflation. And the same is true for Bitcoin mining. So as we saw, Bitcoin rallied over $60,000 a coin and then sell off sharply to briefly below 30,000. Of course, as it's rocketing up to 60,000, more miners are joining the network. The difficulty rate's going up. The margins are getting squeezed even as the price is going up. And then as the price plummets, a lot of those miners were no longer profitable because the cost of production to mine a Bitcoin had gone up so much. Exactly mimicking the gold industry, but on steroids or on nitrous oxide or something, because the percentage moves and the magnitude of the moves in Bitcoin have just been so dramatic by comparison to anything we've ever seen in precious metals. But just a tremendous analogy there. So I really think that the Bitcoin and several others, but just the Bitcoin as the standard that everybody looks to, just absolutely elegantly designed. What a creation. But a lot of it has been borrowed from gold mining. It is any gold miner who takes the time to learn how Bitcoin actually works would just shake their head and say, hey, I know this story. This is something I live and breathe every day.
Right on. Yeah, I want to touch a little bit more on inflation, because you're talking about how that affected with the price going from $250 an ounce up to where it's at now. You said it's what, about $1,750, right? $1,750 an ounce right now. Right. You're not seeing these windfall profits, and that's thanks to inflation. So with like our current inflation rate, like this year right now, they're saying we're sitting at 5.4% in the United States, at least. So what does that rate mean to you or essentially any other investor, especially in precious metals? Why does that matter? Why does that number matter?
Well, let me broaden that a little bit. Is that I think spent my career speaking to various people, to clients, to various media, discussing different investment themes. Here's one that we can talk about that hits absolutely everybody. And it's just an absolutely critical issue. And when I say everybody, it's not just people who own stocks or invest in real estate or have mutual funds. It's everybody. It's 100.0% of people are infected by inflation. Nobody much notices or cares much about inflation when it's a half a point or 1%. And inflation, we could argue that the statistics have really underrepresented actual inflation for many years now. But it's been benign. Whatever, even the most critical analysis looking back over the last several decades, we haven't seen the kind of, or for generations really, you have to go back to the 70s to see the kind of inflation that's really worrisome. But when inflation does pop its head up, like it did in the 70s and has at various times throughout history, repeatedly, it is something that affects everyone and dramatically. And how is that? So if I'm a wealthy investor and I own a number of investments, including a lot of real assets, they tend to benefit from inflation, or at least protect me from inflation. If I'm average Joe investor, or just average Joe, take away the investor, I have a salary that's probably not changing at anything like the rate of inflation. And the cost of everything in my life is going up dramatically. So the cost of food goes up dramatically, cost of housing goes up dramatically. And I'm effectively becoming poorer by the minute. So 0.1% are becoming wealthier at an accelerating pace. So you cannot ignore this issue. It is the single most important economic issue of our day. And it's something that everybody should be talking about and thinking about, how does this affect me and what am I going to do about it?
Yeah, absolutely. Because if you're not investing in some type of vehicle that is at least meeting the inflation rate, you're losing money every year. And I appreciate the tie-in to Average Joe there. I caught that. Thank you.
You like that? Yeah.
So, yeah, good stuff. All right.
Well, let me add one thing. Yeah. Paradoxically, what we generally say, what's the safe investment? Where do I put my money? I don't want to take much risk, but I want to grow it over time. You invest in bonds or fixed income instruments. They're safe, right? Then especially if
they're not even going to give you the return that's going to keep up with inflation.
They're actually possibly the single worst investment and the most dangerous investment you can make right now, because you're not getting fixed income. You're not going to get back more than what you invested, and you're getting interest now, which is pretty close to zero, unless you're in a super risky underlying credit risk. And if I'm right about what inflation is going to look like over the next 10 years, you're effectively going to lose all your money by owning long-term fixed income investments. So it's paradoxically the worst, and I would argue most dangerous thing to be invested in right now.
Yeah, absolutely. Okay, so speaking on that, right? So we're talking about you have to, whatever you invest in, it has to beat the inflation rate. And right now, it's shown to be this year 5.4%. You have to have a significant return to be able to beat that. Now, when you're mining gold, so in particular, like you specifically mine gold. Now, do you mine it in efforts to sell it to investors and folks that want to buy precious metals? Is that the whole point? Or are you mining it? Is the company mining it for its own investment, like investing in your own self because you're mining the gold and you're holding it? Or do you mine the gold and you sell it to investors? How does that work?
We're a smaller company and we sell all the gold that we produce. Okay. So some larger gold mining companies do keep a percentage of their gold, effectively betting on their underlying unit of economy as well as mining it. But for the most part, gold miners mine the gold and they sell it. And they give investors exposure to gold because the profit margin goes up as gold price goes up, not one-to-one, because you have that inflationary effect that I discussed. And also there's a secondary effect. As gold goes in and out of favor, the multiple on gold stocks changes. So as gold is out of favor, you have gold stocks trading at literally 3 to 5 times earnings, just absolutely miserable multiples. As the gold price goes up, and people start to pile into the sector, experience shows us that not only do your profit margins increase, and that can be quite dramatic, which I'll explain in a second, but the multiples increase. So what's that double whammy there? So let's say you're a gold producer and your average cost of production, like my company, is $1,100 an ounce. Gold for the time period from 2013 to 2018 spent a lot of time around $1,100 to $1,300 an ounce. So at times we were breaking even, losing a little bit of money, and on the good days we were making $200 an ounce, and that was our profit margin. Fast forward a couple of years and gold hits $2,000 an ounce. Our costs started to creep up, maybe $50 an ounce. But now instead of getting $1,100, $1,200, or $1,300 an ounce, we're getting $2,000. So let's say on average, we had $150 an ounce of profit margin from 2013 to 2018. We now have $800 of profit margin for this exact same business. So our profits have, quadrupled over that time period. At the same time, as interest in gold stocks goes from zero to something to very interested, goes out of favor to into favor, your multiple might go from 4 times earnings to 20 times earnings. So you get
So I want to ask about that. So there's a lot of people that will invest in gold stocks, right? So in a paper asset, but it's not the same as actually buying gold itself. So how does that affect, I guess, like the price of the actual precious metal itself? When you have like this, I guess, paper asset that is tied to a piece of gold? I'm not exactly sure how maybe is it similar to a bond? Like how does that work, like gold stocks?
Yeah, you raised a really subtle issue here. So I'll distinguish, there's 2 things. There's gold stocks, and there you have specific company risk. So for example, my company operates in Botswana and South Africa, which are both in Africa, and New Mexico, obviously in the United States. So we have risks specific to each of those jurisdictions. We have risks inherent to the geology of our mines. We have HR risks, COVID, all those sort of things. A bar of gold itself has none of these risks. It's riskless. It's just a bar of gold. And 10,000 years from now, if left sitting on your desk, it will still be the exact same bar of gold with absolutely no physical or chemical change, appreciable change. So that's different. You're investing in a company, you can always have company-specific risks, and there's manifold risks in investing in any company. Investing in a bar of gold, you have no particular upside. The bar of gold is just going to be the bar of gold. You're doing that to hedge your risk to other factors, hopefully protect your wealth and perhaps even grow it on a relative basis if you believe that gold is going to go up in value in US dollar or whatever your prevailing currency terms are. The issue, I think it's a really important one that you've touched upon is, what about buying paper gold? Not so much stocks, that's a totally different beast, like my mining company, for example. There are various ETFs and instruments that are listed on exchanges or available through whatever brokers that give you exposure to gold. And some of these are literally direct exposure. They have 1-for-1, the exact same amount of gold sitting in a vault. They don't lend it out. They don't borrow against it. They don't do any like financial chicanery or skullduggery, derivatives and options and all that sort of stuff around it. And those are really good ways to get exposure to it. You still have, the fatalist would say, you still have risk because you hold those shares in a brokerage account. And if the world explodes, that brokerage may go bankrupt and you may never get those shares. And you certainly won't get that gold. But that's a pretty good way to participate in gold if you don't believe the world's going to go into thermonuclear war. There are many other gold instruments issued by reputable entities, ETFs and different tracking instruments, which actually don't hold any gold. They just hold more paper instruments to mimic gold. And those are particularly dangerous because a lot of the reason you own gold, presumably, is you think there are issues with the financial system, monetary policy, the world in general. And if it really hits the fan, those paper instruments, you may have a Lehman Brothers type situation. Lehman Brothers, actually, by the time it was finally liquidated years later, was worth a lot more than it was before it encountered any difficulties. But what happened in between? It was a liquidity crisis caused by counterparty risk. And the liquidation value or the mark-to-market value of those assets went to negative for some period of time, which was the issue. You have that kind of issue again. Maybe your counterparty on your gold, your paper instruments inside your gold investment vehicle is the next Lehman Brothers. And you may never see any return from them. You may have been just absolutely bang on and did the right thing, but you bought the wrong piece of paper. So that's another, it's a very subtle point you brought up, but it's extremely important when talking about gold, which is, it comes back to gold is interesting for catastrophic circumstances. And if there's catastrophic circumstances, you got to think about catastrophic things like maybe a bank doesn't exist that exists today. It may not be there tomorrow. And does my investment still exist then?
I don't like thinking about stuff like that, man. That's scary stuff. But that's a very good point. That's why I wanted to ask that question. So I guess there's essentially three different ways, right? Is one, you can invest in the metal itself and actually buy physical gold. Two is investing in a gold company, like a gold mining company, right? Buying the paper stocks of that particular company. And then three is buying actual certificates, right? Like you said, like the ETFs that have pieces like that have gold in it, like they own gold, and that's part of it. So three different ways to do it. Probably the safest way though is to buy the actual metal itself, get those bars, and you don't have to worry about if the world ends, those bars will still be there unless like an asteroid hits the planet and it's so hot and melts it all down, and we're all dead anyway. So
yeah, it's hard to hedge against that. But look, we've also seen it's happened. It's happened in living memory. I might get my dates wrong, but I'm going to say 1933. The United States confiscated all citizens' gold. You had to turn it in. They gave you money for it. They gave you the fair price, prevailing price. But they took everybody's gold in. And you're really going to be victimized most easily if you have those paper instruments in that scenario. Having some silver eagles or some Krugerrands or other physical gold instruments, great gift, great store of value. And culturally, like it's not something that people in Western Europe or in North America have ever really had. But for much of the majority of the world, and I'll highlight India in particular, it has been for thousands of years and is still a unit of storage of wealth. And that's why it's a wedding gift. That's why it's something that everybody keeps, is some amount of gold, or if you can't have gold, then it's silver. And if you can't have silver, it's some other metals or something of value.
It's the gold standard.
It's the gold. That's why we have the expression. It's not by accident.
Yep, absolutely. Okay, so I want to talk a little bit about like, how do you personally feel about like the traditional stock market, about paper assets, especially being a gold miner? What's your thoughts on somebody who's just investing solely in stocks?
I think, let me go back to my thesis, is that we have so much debt in the system, and in particular at the sovereign level, that I'll use a word from my mathematician days, it's an intractable problem. There is no solution to this. So there's no plausible way to grow our economy, and our economy means the world economy, and it applies in particular to China, Japan, Europe, and North America in terms of the sovereign states with this amount of debt, that any plausible growth scenario, there's no way to pay that debt off. And do I expect the United States to therefore, or the EU or Japan to say, okay, sorry, we're not making our interest payment on our treasuries. Apologize. We'll get back to you when we can. No, that would be the system. The planes would be falling from the sky in that scenario. It can't happen. Do I expect the United States to default on entitlements such as government pensions or other programs that people really don't ascribe any risk to receiving those benefits in future years? I don't expect that either. It's politically completely unpalatable. It won't happen. The route out is not through default, it's through inflation. And if you want to see what the playbook is for the elites and for the powers that be and governments in power, and even unelected officials, and I'm talking about things like the Federal Reserve, who voted for them, by the way. If you want to figure out what their playbook is, they're telling us. They tell us what their playbook is. And for the last several years, they said they've targeted higher inflation and to have that higher inflation rate for longer. And if you look at what they do and what they've done, the policies they've enacted, it matches exactly what they've said. Now they've tempered and say this inflation, I know it's very high, but it's surprisingly high, but it's transitory. So don't worry about it too much. But all the actual actions that they've taken are supportive of continued in very high levels of inflation. And it's it matches what they've said. Their actions are more important than their words in the short term. And it is the path out of this debt load. So let's put some numbers on it. Let's say we're at 140% debt to GDP, the ratio of the total amount of federal debt in the United States to the size of the economy to GDP. And economists would tell you you're past the point of no return at that. You're hit escape velocity and debt's going to spiral out of control. How do you get that back to something sustainable? Say, let's make the math easier. Say we're at 150% debt to GDP. And we want to get to 50% debt to GDP. You're not going to do it through austerity. You're not going to cut spending so dramatically that you're going to pay off $30 trillion of debt. And that's literally the numbers that are at stake. It's impossible, politically impalatable, just impossible. You're not going to go that fast, like legitimate growth. You can have all the productivity gains from the internet that we saw. Now AI, robotics, machine learning, all sorts of great things are happening. They are driving real productivity gains. You can't grow that fast. It's just not possible. But if you add inflation, if you add huge inflation, so you're just growing the denominator, that debt number is relatively fixed. If you can keep borrowing on these incredibly miserly terms, paying 1% interest or 2% interest or less for short-term instruments, and you're growing your GDP number through inflation, you can get it back. So let's say you have, I'll put it in very real terms, a house it costs you $1 million today. And you say, I can keep my $1 million of cash or buy this house for $1 million. And I have this huge amount of inflation going on in the economy, and the central bankers and the powers that be are driving us to this long trend of inflation. And in 10 years, they've succeeded. We've had huge inflation. And now my one friend decided to keep his $1 million and put it in T-bills. He now has $1 million and $50 or whatever, some nominal amount of interest that was earned over those 10 years. Almost nothing. But he still has his $1 million. The other friend took that $1 million and bought a house and enjoyed living in it for those 10 years. And that same house, it's not a nicer house. It's not on a better street. It's exactly the same house that it was, just 10 years older, but the same house that he bought today is now worth $3 million. Is that person who has a $1 million house that's now worth $3 million, is that person richer? Probably not, if that growth was caused by inflation, but they've protected their wealth. What about the person who had the $1 million in T-bills and now has the $1 million and $100 interest? They still have their $1 million. They're legitimately poorer. They've lost 2/3 of their wealth. That's been wiped out through inflation. Inflation is slowly robbing everybody's wealth every single day. It's shrinking your salary, and it's robbing you of your savings day by day. The only way to protect yourself is with real assets that mimic or participate in inflation. And maybe if you do a really good job of it, you can actually beat inflation and participate in inflation in a levered way and actually grow your wealth.
Yeah, I'm a big fan of real assets. It's why I'm a big fan of real estate, because it's a tangible asset. It's something that's a need. There'll always be a need. Somebody will always need a place to live. And it's something that does go up in value over time. Like perfect example that you gave there with the person that, bought the $1 million home. 10 years later, it's worth $3 million. Sure, you have appreciation, but the thing is, did that appreciation keep up with inflation? Most of the time, like in pretty good markets, you're going to see like the appreciation between 2.5% to 3%, which is around the target inflation mark. But then you look at years like right now, where inflation's at 5.4% for this year. And if you appreciated 3%, well, you actually lost 2.4% of value realistically when you compare it to what the inflation rate looks like. And I think a lot of people don't really look at it that way, especially like when you look at if you're a salary worker, especially federal workers like myself right now, cost of living, we get cost increases every year. We get our pay raises in January. And it's typically between 2.5% to 3%, sometimes as low as 1.5% I've seen sometimes. Now, I think this January, we're getting a 3.1% or something like that. But as you can see, that does not equate to 5.4%. So we are slowly getting less money as the years go on. So yes, totally understand that. So I'm trying to explain it in a way that if somebody who's a little bit confused while they're listening, that's just one of the ways to just show how, like Ravi was saying, you're slowly getting robbed of your wealth, slowly getting robbed of your wages and your salary and things of that nature. So it's important that no matter what what asset class you're in that you're beating that inflation rate, that you're beating that this year 5.4%. Who knows what next year could be? It could be higher, maybe lower, who knows? But that is one of the ways to keep up, and I guess for the government to buy back some of their debt in that way. But
they're shrinking their debt in real terms,
right,
by driving that inflation. That's how you shrink it, and it's just a master stroke that, like, if you could, all goes according to Hoyle, and if you bought a piece of real estate that just matched inflation, but you did it with a reasonable amount of leverage, and you're able to lock in rates at today's prevailing rates for a long enough period of time, you can really do dramatic things for yourself financially.
Yeah, you can essentially beat inflation.
Exactly. It's very hard for all of us today to wrap our heads around the concept of inflation because we haven't seen it. Unless you were a homeowner or trying to raise a family in the 1970s, you've never experienced real significant, or you're in Venezuela or Zimbabwe or some other country that's experienced inflation at levels that we just haven't ever.
Yeah, they experience.
It's hard for us. But the other thing to wrap your head around is a term, negative real rates. And your real rate is your interest rate that you're getting, and you got to subtract inflation from it. So if you're getting 2% on your fixed income investment, whether it's T-bills or corporate bonds or what other investments you have, but inflation is 12%, then you have a negative 10% real return. You're still earning a positive return in absolute terms, but your real return is actually negative. And we saw deeply negative real yields during World War II. We also saw it during the Civil War, although the data is harder to really accept given the timeline involved there. But certainly rates went wildly negative. They were negative double digits during World War II. And that's how the United States got out of debt to GDP in excess of 100% in that time frame. We had several other tailwinds back then too, coming out of World War II. You had a legitimate peace dividend. We're coming out of a world war against COVID now, but there's no real peace dividend. We're just going back to normal, hopefully, maybe. And you also had a demographic tailwind there. You had the baby boom. We don't have that, certainly not in any of the major economies right now. We don't have this big demographic boom that's driving consumption and driving economic growth. In fact, in several key economies, China and Japan most notably, you have a demographic contraction and you have a real tailwind there. The only path out of this otherwise intractable situation is inflation. So we have the policymakers telling us they want inflation. We have the policymakers enacting policy that creates inflation and continuing it. And mathematically, the only path forward is inflation. So I think we should expect continued inflation and try to invest accordingly.
Yeah, no, I agree with that. I think that's solid advice because, again, you really can't say this too much. Like that's the goal to beat. No matter what the inflation rate is, pay attention to that because that is what you want to strive to beat, no matter what you're investing in, no matter what your vehicle is in. Like you're saying, there are safer assets to invest in, like real assets that will last if something happens. And then you have your paper assets where you do run risk if something was to happen to the company or anything like that, which is why it is super important. We talk about on this show a lot is diversification and making sure that you don't have all your money dipped into one pot, right? You don't have all your eggs in one basket. Because if you drop that basket and they all crack or you're just left with one, then you're down a whole lot of eggs and people are going to be hungry. It's important to definitely diversify no matter what route you go. But again, I like what you're talking about too, with having these real assets. It's super important. And so speaking of real assets, when you talked about collectibles earlier, you had lumped in NFTs with those and you were talking about them as real assets. So I'm curious as to why you think an NFT could be considered a real asset.
I'm changing the definition of a real asset. So somebody might just say, like, that's not a real asset, it's a digital asset. But I think what we really meant when the term was defined, certainly it meant something physical you could wrap your arms around when the term was coined, and that's why it's a real asset. But it's really something that's immutable. So let's start with the basic block is like a bar of gold. So it's the same bar of gold in 10 years. A piece of real estate. Okay, a building does depreciate and change over time, but a building now is a building in 10 years. Maybe it's depreciated, maybe it's not. Still a building. A piece of land, still a piece of land. NFT, still an NFT. That doesn't mean they're good investments and they won't be wildly volatile. They may be great investments. There's going to be some disastrous ones. I suspect most of the NFTs being created now in this sort of experimental growth phase are going to be disasters minus in the 100% kind of thing. But fast forward 10 years from now, I think we'll see all sorts of things that, unitized as NFTs that are real assets. Some of them actually won't be real assets either, but collectibles, it's creating a whole new genre of collectibles. Like I could say Ken Griffey Jr. rookie card, or insert your favorite sports from Canadian. So Wayne Gretzky rookie card, is that a real asset? It's a piece of paper. How is that worth hundreds of thousands of dollars? It is, because somebody's willing to pay for it. And it's Wayne Gretzky rookie card. So if I have an NFT of the first tweet from @Jack, I think that's pretty cool. I'd love to own that. If I was a crazy billionaire, I'd love to own a few of those things. Like, those are worth something, and I have no idea what it'll be worth in the future. But it's also immutable. It's not, if I'm right and the denominator's changing, and we have this wild inflation, and if somebody's willing to pay $1 million for it today, maybe in 10 years they'll be willing to pay 10 million or 20 million for it. And maybe in 100 years, it might be absolutely priceless. So I think there's a whole new genre of real assets, and the sort of definition of the term is going to change with the advent of a digital way of capturing real immutable assets.
That's fair. Yeah, I wanted to get a better understanding, because when you said that, I wrote that down too. I was like, wait a second. He said NFTs, and he's tying that in with real assets. I want to get down to the nitty gritty of this. What's he talking about here? That makes perfect sense. That makes perfect sense. That it's something that will, could just continue to retain a value, right? Maybe not the same value. It'll probably go up in value, especially as years go on and it becomes a little more rare or more of a historical piece as we start to age. Just like we look at precious artwork and the way artwork is traded nowadays, right? You can look at NFTs in the same kind of light, I guess you could say.
Give me some rare piece of art and it is going to be worth a huge amount of money. Mm-hmm. And it is not worth that on any sort of traditional economic measure. There's no NPV or discounted cash flow that says the Mona Lisa is worth $500 million. But it may actually be worth $500 million because there would be a lineup of people willing to pay it, because they know that in 100 years, it'll be worth $500 billion or insert higher price here. Similarly, is an NFT of a tweet or of a moment in time or a video, whatever, is that any less real than a painting or a Spider-Man #1 comic or what have you?
Nice.
What's the difference? It's not a piece of land, but there are real assets that have utility, like land or a building, and there are real assets that are effectively collectibles that are really something that people are owning because they know there'll be somebody who's interested in buying it in 10, 50, or 1,000 years. And NFTs can certainly check that box.
Absolutely. No, that's awesome. I appreciate that explanation too, because when you think about that, it's just something that any type of collectible, like you had mentioned the Wayne Gretzky card and things like that. I remember as a kid, like that was the biggest thing. Like when we were trading like baseball cards and basketball cards and stuff like that. That was always like the big thing, trying to make sure you try to get the rookie cards, try to get Michael Jordan's rookie card or Shaq's rookie card and things like that. And that was like always the big thing to try to get, or like a college card. And some of those things are worth like a ridiculous amount of money. I used to play this game back in high school called Magic the Gathering. And I used to have this one card, and I sold it a long time ago for $900 or whatever, but today can get you 6 figures. It's absolutely insane. And I'm really disappointed that I don't have that anymore. But so there's things like that just the value goes up because they're rare. There's less of them around. And then as time goes by, there's even less of those pieces because they start to dissipate, get damaged, ruined, whatever, or they just start to disappear. And so I guess you could look at NFTs the same way. And there's multiple things that could be looked at that way. It doesn't just have to be NFTs. So like we talked about artwork and other things. Yeah. So real assets, not just has to be tangible, not something you can hold and touch, but just real assets in general is something that's going to keep you safe from, I guess, end of world events or catastrophic events if you survive and things like that, or economic meltdowns or companies going bankrupt and things like that. There's other emergency things that don't have to be so dark. Like I keep bringing up, you talk about companies going bankrupt. I talk about an asteroid destroying destroying the planet. So yeah, I guess I know where my mind's at right now. I don't know, but at least you're keeping it within the finance realm. And I'm just talking about the end of days. It's crazy. But hey, man, this is super cool. I was definitely interested in learning like how you do this and why mining gold versus mining Bitcoin. And then you did it too. So you also mined Bitcoin. Was there any other cryptos that you mined? Just curious.
No, the specifics to mining, it's like any other industry. It's really institutionalized. And so, of course, when you have these price spikes, anybody can make money at it. But I'd say to be consistently profitable in crypto mining now, you have to have laser beam focus on being in a jurisdiction where you have stable, low-cost power. You have to have access and the liquidity to buy the hardware required and continuously replenish that, because the life of it is very short. Your chips get out of your mining equipment becomes obsolescent very quickly. And so you really need to also have the liquidity to keep buying it and replacing it, even though the price of your underlying coins might be low, because the price of that hardware tracks with leverage the price of the underlying coins. So if you're trying to buy Bitcoin mining hardware where Bitcoin's at $66,000 a coin, you are going to be paying through the nose, and you will be very hard pressed to cover your costs. Yeah. But if you're just continuously buying it, whether Bitcoin's at 10,000 or at 60,000, you can do that. So you have to have all these things working for you and have laser beam focus on it. Of course, the large scale miners have diversified. They do have some capacity dedicated towards different coins, different strategies, and that's the right way. My dalliance into it extended only to Bitcoin. And unfortunately, I could say I started mining Bitcoin when it was in the mid-teens, and then it tracked it to sub 10,000. And I found that I couldn't earn a positive margin with the operating costs, that I wasn't able to do it. So I had to stop mining Bitcoin, or otherwise I would continue incurring losses. Of interest, and this is about 3 months old, I looked at restarting the equipment that I had in 2018 and was no longer profitable with operating it at. And I thought, well, Bitcoin's moved up sharply. Can I restart mining without capital expenditure for new mining equipment? And I worked out an operating cost of $120,000 per Bitcoin. This is when Bitcoin was at about $40,000 on the way up. So what had happened there is my equipment was just so old, it was about 36 months old, that it was no longer competitive. And that's a calculation on a piece of paper. Would I actually have won any blocks? It probably would have been 0 blocks won due to a variety of issues. So I would have gotten no coins. But if it had all gone according to the calculation, it still would have been a huge money loser. So underscoring the point that to be competitive in it, like any other industry that's matured and grown up, you got to be low cost, you got to be laser beam focused on it, you have to have critical mass and scale, and you have to have costs that are competitive on a global basis. It's truly a global industry. And so, again, long answer to a very simple question. No, I was just focused on Bitcoin, didn't try any other coin. Similar argument applies to all of them, but I only ever ventured into Bitcoin myself.
Awesome. Yeah. So it reminds me of every time you hear about when the gold rush happened in California, everything like that, and everybody was like so focused on getting gold, but the guy who really made the money was the guy selling shovels and pickaxes. So it's having those supplies. So it brings me back to, it was actually a couple of weeks ago, I was driving to work, and when I drove by Best Buy, there was like this line out the door, tents, like people camped out. It's like, what game came out, or what's coming out right now that is, and they were selling GPUs, right? And I guess there were these systems that they were selling for like $1,500. And then next thing you know, you see them all for sale, like on the local marketplace on Facebook and local groups for $2,500 plus. And it's, oh my goodness. And people were buying them up because they were using that for mining. And it's just absolutely mind boggling, especially out here in Hawaii, where electric prices are pretty high. But a lot of places out here, like including my house, like I have solar power and stuff like that. So it's definitely something you want to have out here. But yeah, I couldn't believe it. I was like, what the heck, what's going on? And I was asking somebody at work, and they said, oh yeah, they were selling GPUs today and they were selling them at this price. And this is what I was like, oh my goodness. So yeah, it definitely reminds me of the whole like gold rush thing with the shovels and the pickaxes versus who was actually out there mining it. And then you had to dig in the right spot. You had to find the right spot to find the gold. And you see the same thing in crypto right now too. If you're not doing it the right way, you're not going to find anything. You're not going to get your coins. And it's a lot of work. It's a lot more work than people think it is. I'm glad you pointed that out. So Ravi, this has been awesome. I feel like I learned so much today. I got a whole page of notes here. I really appreciate you educating me and educating our listeners on gold mining and how it works and why it's important to have these real assets to combat what we're combating right now with inflation. I think it's a super important topic for people to understand and learn. With that being said, do you have any last tips or tricks that you would recommend to somebody they just got themselves out of debt and they want to start investing and they want to play it safe and start investing in maybe precious metals and gold and things like that? What kind of recommendations would you have for somebody today?
Yeah, well, broaden that to real asset investing that can protect you and help maybe even grow your wealth during this, what I expect to be a long period of inflation. Real estate investment trusts. So not every investor can buy their own investments, their own real estate directly. It's a big numbers game. Even if you're making a personal level real estate investments, it's just bigger numbers than many people can handle. So real estate investment trust, by investing in something you can understand, buying something that's like a retail strip mall real estate investment trust, maybe that's not a good idea. There's obviously going to be subsectors within real estate that are going to get disrupted and Amazon effect and different things happening. But generally speaking, real estate investment trust could be a great opportunity to get that fractional ownership in real estate that's going to pay you a return and participate in inflation. Buying a basket of gold mining shares by buying an ETF, that's a good way to participate without having so much one specific company risk. I like to think my company is great, but again, every company has its own risks. And if you're a new investor, you got to diversify as much as possible. It's very hard to do that with shares yourself. Very easy to do it. So gold mining ETF is a great opportunity there. And the last one is get some American Eagles, get a few coins. And anybody I know who's done that, nobody's regretted it. As long as you can park that, you can put it in a safe or safety deposit box and be comfortable with that investment, particularly if you can have access to it. Just for those people who've seen them and held them in their hand, it's a great feeling. And it's going to be a great investment for people. So that'd be my final recommendation for people to dip their toe in the water.
Yeah, great advice. I definitely appreciate that. So I've got one more question I have to ask you, and this is a pretty important one, right? Especially for the listeners that are listening and saying, hey, I want to know more about Ravi and where can I find out more information about him? So with that said, where can people find more information about you? Do you have a website you can share with us? Any social media people can follow and check you out?
I'm pretty invisible on social media with the exception of LinkedIn, where I'm quite active. And I point out to people with my renewable energy company, as an example, I think we've done 6 acquisitions in our 8 years of existence, but one of them makes up about 50% of the business. And the idea for that originally came through a cold outreach through LinkedIn. You just got to keep showing up. So I love when people reach out with ideas. Sure, a lot of them are crazy. Some of them are scams, in fact, but a lot of great stuff happens over those connections. So I love to hear from people that way. And of course, my company, Galane Gold, you can find out more about us at our website, but the best way to interact with me or anything I'm doing, LinkedIn.
All right, fantastic. So I'll make sure we have a link to your website and your LinkedIn in the show notes. So everybody can go and check that out and get connected with you and have those conversations. I agree. LinkedIn's a powerhouse. Absolutely love it. I've actually found podcast guests on there. And it's been super fun to just interact and network with people there, because that is definitely one of those social media apps where you build a network that is more towards building your net worth versus like all the stuff on Instagram and Facebook and all that other stuff. LinkedIn's a whole different animal, and it's all about being professional and professionalism. And I really enjoy it. So definitely a powerhouse to check out. If you're not on there, definitely get on there. But Ravi, it's been an absolute pleasure having you on the show. I really appreciate you taking some time to chat with me today. Thank you so much.
It's been great.
Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.